Welcome back. You're watching Your World at 10. Now, the GDP numbers for the Eurozone expanded by 1% in the second quarter. That's from the first, and by 1.7% versus the second quarter of 2009. That's year on year. Germany seems to be the engine of growth. That's quite expected, with 2.2% growth in the second quarter. That's the fastest since the country's reunification in 1990. So is the worst over for Europe? Well, joining us to answer that, Stefan Schneider, Chief International Economist and Head of Macro Trends at Deutsche Bank Research. Stefan, thank you very much for your time. We've had some very good numbers come in from Germany, equally so from France, but then disappointing numbers from Greece yesterday. So what do you make of the growth picture in the EU? And then we'll try and break it down into individual trends.
Yeah, I mean, the overall growth picture is actually quite good, better than expected. 0.1% quarter on quarter, but actually, you're talking about the breakdown, half of that comes from Germany. So if you look at the country-specific level, you get quite a complex and divergent picture.
Stefan, this was not unexpected, right? Germany driving the engine of growth in the EU, and yet these numbers have come in far higher than what analysts expected or economists expected. What do you qualify as the reasons for the stellar growth in Germany and whether it's sustainable or not?
Yeah, I mean, one has to see that analysts have become a little bit cautious with their quarterly forecast because of the last 2-3 quarters. Actual growth numbers turned out lower than analysts' forecasts, so we cautioned a little bit. Actually, our internal models were indicating 2%, but as I said, we were a little cautious, and so we stuck with a somewhat lower forecast. So the number doesn't really come as a complete surprise, especially given monthly data and the most recent jumps we have seen in the IFO business climate and the PMI. But obviously, we have seen a accumulation of several factors. One was a bounce back from harsh weather in Q1, which has positively affected the construction sector. Plus, it seems that the global recovery, the export recovery, is actually at its peak. And Germany, as a producer of capital goods, is benefiting from that overproportionally. So I guess 2Q is obviously as good as it gets. We'll still see decent growth in the third quarter. We are expecting something like 0.75 percentage point quarter on quarter, but a slowdown thereafter, especially given that we have seen some weaker numbers from major trading partners like the US or China.
Do you believe, Stefan, that the positive news, with regards to Germany is in fact a negative for the other struggling economies in the EU, the pigs economies as they're referred to?
Not really. I mean, one has to see that it's export-led, but it's not exports vis-à-vis other European countries, which would mean that Germany is actually borrowing growth from these countries. The export performance is especially strong for Asia, and then you can even say that a part of German exports are imported pre-products from other European countries. So there is some positive spillover from the German performance to the other countries, but it's not that Germany can actually be the growth locomotive for the rest of Europe.
All right, if you were to leave Germany out of the picture, how is the rest of Europe looking to you? Because yesterday the Greece numbers came in where GDP has contracted 1.5%. We've seen a minor bump up, in fact, in the unemployment figures for Greece. So when you look at the overall EU picture, if you were to take Germany out of that picture, are you still feeling reasonably confident for the third quarter for the EU growth number?
Yeah, I mean, if one takes Germany out of the equation, actually EMU GDP growth comes in at 0.5%. So basically, it's still quite a decent number. If you annualize it, obviously we're talking 2%. So this is okay. I mean, you are alluding to Greece. You have to see that Greece is going through harsh austerity measures, and therefore it doesn't really come as a surprise that the GDP has dropped by 1.5% in the second quarter, and that we see some negative effects on the labor market. But overall, the IMF and ECB, they have just launched their first report on the progress in terms of Greek consolidation, and they were quite positive. They also were quite positive on the GDP outlook, but it's clear that this year Greek GDP will contract by 4, maybe 4.5%, and maybe there will be a further year of contraction next year. But that's really a very special factor given the consolidation measures and the austerity programs. In the rest of Europe, growth is picking up somewhat less than in Germany because Germany is benefiting overproportionally from the world trade because of its big export exposure, But I mean, countries like France or Spain or Italy are doing okay, and I guess that will, to a certain extent, carry over into the third quarter. But again, the numbers for Germany and for the Eurozone as a whole will be somewhat weaker than the second quarter numbers.
Okay, so when you say somewhat weaker, I also want your comments on the two big challenges. One that you already alluded to, which is the slowing recovery in the US, as well as sort of a soft landing in China. And when you factor that challenge in, what are you expecting in terms of Q3 performance across the EU? And really, will it impact Germany, which is the big exporting country there, in a big fashion? And I'll come to the second risk in just a bit, which is the currency risk.
You're right. I mean, we have seen the PMIs in China and the US trending down for the last 3, 4, 5 months. And obviously, this has an impact especially on German exports, because Germany is a big producer of industrial goods. And if the industrial sector in those countries is slowing, then it will have a negative impact on Germany. Therefore, we expect that the stellar export performance we have seen in the last few months, that this will start to slow down going into the second half of the year, and that export growth in terms of GDP, which could come in at 12% this year, will slow to something around 6 or 7% next year. This is also one reason why we see German GDP growth to slow down after 3.5% this year to around 1.5% next year. Given that the export side is not so extremely important for other European countries, this effect is visible there, but to a minor extent. Therefore, yes, we will see a slowdown there as well, and the Eurozone GDP growth should be somewhere like 0.3, 0.4 for the quarter, and probably for the year as a whole at 1.4%, slowing to 1% next year.
And what kind of role will the currency play in this? Do you believe that the Euros had a big part to play in this strong GDP number that we've seen for the Eurozone? And if we see a strengthening of the Euro, so to speak, over the course of the second half of this year and next year, then what kind of dent will it make in GDP growth figures?
I mean, if you look at the euro trend, I mean, there was not really a clear trend over the last 12 months, and you have to see that exports are affected by exchange rate movements with a time lag of something like 2, 3, 4 quarters. So one has to look what happened basically at the end of last year to get an idea what the effect on German or European growth might have been in the second quarter. And so overall, if you look at the euro, it has actually weakened a little bit over the course of 2010 so far. We expect that it might actually strengthen a little bit. So some of this marginal tailwind we might have experienced in the first half of the year might disappear in the second half of the year and going into 2011. But I don't think, given the quite close fluctuation band, that the exchange rate will be the driving force for overall exports, or let alone GDP growth.
So you're saying that all the worries regarding the EU or the impending crisis is definitely behind us?
Never say never. That's the lesson we have learned over the last 2 years. And I mean, you can see that there are still problems. I mean, if you look at Ireland or so, and that people are questioning the funding ability of those countries. But obviously, all these issues can be handled in a much more relaxed way if we have a somewhat stronger growth in the Eurozone compared to an alternative scenario when we're talking about recession or so. So in this respect, it's not behind us, but I think the focus, there was an exaggeration in terms of the Euro crisis to begin with, and now the focus is shifting on something else. So I guess the problems, there are still some structural problems, but there is now more time to sort them out and less pressure from markets.
All right, that's excellent. Stefan Schneider, thank you so much for your time and your views, and thank you for joining us on Your World at 10. With that, we